So today we're going to talk about how to calculate compound interest in a whole life insurance policy. We're specifically talking about the cash value growth, but we'll start with how to calculate compound interest. So let's start with the very basics. And to do this, we'll pretend that you've got money in the bank. We'll call it $10,000 and your bank account is earning 5%. How can you calculate the actual interest in the first year and also future years? Let's start with year one. So again, you've got $10,000 earning 5%. What would your account balance be after 1 year? Well, you can do this with a calculator, and here's how. What I want to start with is my account balance. So let's plug in $10,000, and then I would multiply that by 0.05. That'll give me 5%. If I punched in 0.5 without the zero in front of it, that would give me 50%. So I want to make sure that I put that zero in there first. That gives me $500. That is how much interest I am going to receive from the bank in this example. Make sense? All right. So then what I would do is add my initial $10,000 to that, $10,500. Okay. So now, after 1 year, our account balance is $10,500. Let's pretend for the next year, I earn 5% again. So what I want to do this time is multiply 10.5 by 5%. So let's do the same thing. We've got our 10.5 already. So we can multiply that by 0.05. That gives me $525. That's how much interest I'm getting from the bank. And then I would add my $10,500 to that interest, $11,025. All right, let's punch that in. Fun stuff, right? Okay. So if I continue to get that 5% for 10 consecutive years, after 10 years, what would my account balance be worth? Well, we can do what we just did for 10 years, just keep on multiplying it by 5% and adding it to the balance. However, there's a much easier way. One thing you can do is Google it. You can Google search a compound interest calculator. Another thing you can do is use handy dandy Excel. So here is a quick workbook we put together. We've got $10,000. We're assuming a 5% interest rate. And after 10 years, the balance compounds to $16,289. Now, what if we only earned 3%? Well, we see it impacts the balance, especially over the long haul. So compound interest represents the fact that I earn interest on my initial investment plus the interest I've earned from prior years. So the first year, I started with 10, then I got 500. That's 5% of 10,000. And then the next year, I get 5% on 10.5. So it's compounding and getting larger and larger. Make sense? Cool. All right, so that's step one. Step two is adding money to it. So let's pretend you've got that same account. We're going to look at the same 10-year period, but now you're going to add money to it every year. And we'll pretend that you add $10,000 every year to your bank account for the next 10 years. We'll assume you get the same 5%. What is it going to be worth after 10 years? Well, we can do this with a calculator. However, we're just going to use Excel. And you can Google search this as well. I would just Google search compound interest calculator, and it'll give you a calculator that'll tell you the exact numbers you're going to see here. So let's punch in a yearly contribution of $10,000. We want this for 10 consecutive years. And what do you notice? Well, now, with me adding money to this account, I'm at $142,000 and change. So $142,068. Not bad, huh? just by regularly saving. Why do you think there's so much information out there about just putting money away and letting the interest accumulate? Here's why. It gets bigger and bigger over time. And we're just using a 5% return here. Now, here's a question. What did I earn? We'll have some fun with this. If you have $100,000 and you add $10,000, then your value is $115,000. How much interest did you earn that year? Was it $15,000 or $5,000? The answer is $5,000. So I was at 100, now I'm at 115, which means my account balance is worth $15,000 more than it was during the previous year. However, $10,000 of that is my money that I added to it. So if I wanted to know just what I got from the bank in this case, it would be everything above what I paid in. Make sense? All right. So how does this work if I'm going to look at a whole life insurance policy? Is it different or is it the same? Well, it's the same principle when it comes to compounding, but because it's a life insurance policy and the industry does not make things transparent, it is much different. So, some tips here. The dividend rate will not help you at all. I would not recommend looking at that or the dividend column on a life insurance illustration. An actual illustration is sometimes helpful if you're trying to see how much your money is growing by every year. I'm going to pull up an illustration and show you what insurance companies show sometimes. It can be confusing. But before we do that, here's what I would look at. For the first year, it's pretty simple. What's my cash value? And then subtract my payment from that dollar amount. And what you'll notice is that in the first year, you're always going to have a negative return. And the reason why is because I have the insurance expenses associated with the policy. Let's take a look at that real quick, actually. So here we go. First year, you paid $10,000. You have $8,770, which is what? How much money did you make? None. You lost a little bit less than $1,300. That will come out to what? $1,230 is what you lost there. That's important. All right. So we took a loss. So the first year, again, just take my payment minus my cash value. That's what I want to look at there. Or I should say my cash value minus my payment, because that'll give me a negative number, which I want because that's making it transparent. The second year, here's what I want to do. Look at the second year cash value, CV, minus the year one cash value, then minus my payment, that's what I'm adding to the policy, and that will equal my cash value growth. So what that means, we started with the second year. So I want to take my second year cash value here, $18,936, minus my first year cash value. Let's do that actually. Let's take a look at our calculator. So first year, we had what? Let's do it just like this. 18,936 minus 8,770 equals $10,166. But then we also want to subtract our second year payment. So then I would also subtract 10 grand, and that's what I actually earned in the second year, $166. So that's how I calculate the second year cash value growth. And then from the third year onward, I just repeat that. And it's the same thing every year. I'm going to show you exactly what that illustration is growing by every year. But before I do that, let's look at an illustration. And I want to hit on the point I mentioned here as far as this being sometimes helpful. So using the same illustration, here's what we just looked at. with what we just covered about the cash value growth, let me know if you think this is helpful. And if you agree with it. You pay $10,000. You have $87.70. This column says increase in net cash value. $87.70. It's saying that the net cash value column increased by that dollar amount. So from the insurance company's perspective, that is true. However, when you see that, what does it make you think? Do you think that's how much your money is growing by? A lot of times people think that. That's not the case, is it? What about the next year? $10,165. We came up with $166. Maybe I was off by a penny. But the net growth, if we back out our $10,000 payment, would be $165. What we can do for the first 10 years in this example, if we just cut that off, that's what we're actually earning that year. So let's take a look at the same policy, but on Excel. So here we go. Here's our compound interest calculator. Here's what we're going to look at. So same policy. First, we've got what we just saw. So here's the insurance company's report. This is showing in the first year a net cash value increase of $87.70, which matches your first year cash value. The second year, it's showing an increase of $10,165, but you added $10,000. So what I like to look at, and what most people like to look at, is the net growth. What this is going to isolate is how much you're getting from the insurance company net, not including your payments, just what did I get in total dividends and interest from them. And what you'll notice is when you're paying money in, these numbers are going to be different because that column we saw in the insurance company's report is always going to include your payment. But once we stop funding, if we ever do, then you'll notice that they're the same because the cash value growth is just what you're getting from the company. And if you're not paying anything in there, there's nothing to continue to add to that balance. Make sense? But what this is showing us is the compounding we're getting every single year. And if we wanted to see a percentage, we could back into that and include a rate of return column. But we won't do that in today's video. We'll share that for another time. So I do hope that this video was helpful. Would love to hear any thoughts, and if you'd like more videos like this where we go through some of the basic principles as far as calculating returns on money and then how it ties to cash value life insurance, feel free to leave any of your thoughts in the comments below. And as always, I hope this helps. Thanks so much.